Good morning and welcome to this Monday, March 7th, 2022 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes featuring everything you need to know as you prepare for the trading day ahead. Well, more red over the weekend. Last night, futures were down quite a bit. But they have rallied back this morning. I'm not surprised. We've seen this multiple times over the last couple of weeks where futures look like we're going to get hit really hard. And by the time we actually open, either the futures, those red futures have come down quite a bit, or sometimes they've actually turned to green. And we're seeing that again this morning as we get closer and closer to the market open. We're getting closer and closer to the flat line as well. Currently, well, this is on a little bit of a delay. We've got Dow futures down 148, S&P futures down 17, NASDAQ futures down 57, but that was 10 minutes ago. And I know that things have gotten a little bit better. In fact, let me take one look at another place I can give you. Sometimes I just go in and use the symbol summary over at stock charts and just pull up the ETFs that track the major indices. So for instance, right now, the diamonds, I'm showing about 0.45% decline. The spiders 0.34. Actually, that's close to what I was giving you just a couple of minutes ago. So it looks like maybe things have flattened out here a little bit. The QQQ down about 1/3 of 1%. That tracks the NASDAQ 100. So all in all, not bad considering where we were about 12 hours ago. 12 hours ago, I know the Dow went down. I think the highest I saw the Dow was down over 600 points and now 150. So things have definitely improved a little bit overnight. Very much the same news. A lot of talk about the Russian and Ukrainian conflict. They've tried to have a couple of ceasefires to let folks evacuate in Ukraine, and apparently Russia's not really cooperated with that effort. And so there's a little, pretty big issue there. Crude oil prices, which are up about $3 a barrel right now. That's a lot better than what it was 12 hours ago. 12 hours ago, I think at one point I saw crude oil was up $10 a barrel to about 126 right now. And actually I'm seeing a headline said it went over 130 at some point. Anyway, it's 118 right now. So it has come back down quite a bit. The 10-year Treasury yield, which was dipping down into 160s overnight, now it's 1.79. So there's just been all this, fluctuation. So the volatility that we're experiencing isn't just during the trading day. It's been throughout the day, whether you've been watching outside of normal market hours or not. It's still that volatility is still out there. Anyhow, it's been kind of a really crazy couple of months. I mean, we're now into the third month of 2022. I'd like to say I see that things are going to get better. I haven't seen that yet. I do see some the sentiment shifting. I talked about that at the beginning of the year. We really need to see the sentiment reset. I'm definitely seeing some of that. So that's a good thing. I'm not seeing any signs that Wall Street is expecting some kind of a major reversal in the market. I'm not seeing the risk on, sometimes you'll start to see positive divergences. The market moves lower, but you start to see money moving into other areas, some aggressive areas. Not really seeing any of that at this point. So that makes me a little bit nervous. And we're going to talk about that in just a couple of minutes. Anyhow, let's take a look. Let's go ahead and get this thing started. Let me get your screen up. All right, for those of you who are new to Earnings Beats, always like to start off with our homepage over at earningsbeats.com. If you want to learn more about us, if you like the show and you read my blog, I think you probably really like our Earnings Beats Digest newsletter. It's a very quick read. If you scroll down our homepage, you'll see an opportunity right here to sign up. It's a 3 times a week newsletter, Monday, Wednesday, Friday, focusing on the things that we feel are important. All it takes a name, email address, no credit card required. You can unsubscribe at any time, and we will not sell a list of email addresses to anyone. So third parties are not going to get your information, at least not through us. So you don't have to worry about that. This is really just designed to give back to our community. 3 brief articles, like I said, a couple paragraphs and a chart. Normally, you can probably read through and look at the chart in less than 5 minutes in the morning. And normally it comes out around 8:30 in the morning. So it gives you some time to look at it before the stock market opens. I'm sure some of you probably use it to trade from time to time. That's completely up to you. We're not registered investment advisors, so I like to throw that out there from time to time. I'm not recommending anything for you to buy or sell. It's really educational information. If you choose to trade using that information, that's completely up to you. But anyway, we'd love to have you. We do free events from time to time. And when we do, we reach out to our EV Digest community. That's how you're going to get room instructions and that sort of thing. So it's not just the newsletter, it's also free events. And we do a number of those throughout the year. So if you'd like to attend those from time to time, then being a part of our community and being part of that newsletter is really important. All right, daily market recap. Let's take a look at what happened on Friday to close out last week. Dow Jones Industrial Average down 180, S&P 500 down 35, NASDAQ was down 224 points. So on a percentage basis, the NASDAQ was down more than double the S&P 500 and more than triple the Dow Jones. So on a relative basis, NASDAQ getting hit hard again. Mid caps and small caps not hit quite as hard as the NASDAQ, but they were hit harder than both the Dow and the S&P. So they were down 1.58%, 1.36% respectively. Leading to the upside, energy. I mean, while this conflict's been going on, there's a lot of talk about sanctions against Russia not taking their oil. Well, that's going to create a supply issue. If you decide, this is kind of a, you want to do the right thing, which, everyone, I guess, has a different opinion. I'm not going to get into the politics of it. But, sanctions, you want to do some things to kind of force Russia to maybe back off of their, attacking of Ukraine. But those same sanctions reduce supply. I mean, you're still going to have the same amount of demand. I'm still going to drive my car around. Everybody else probably still going to be doing that. Well, if you don't have the supply of oil coming in from Russia and there's no other supply that you're drawing from, well, all of a sudden you got a lot more demand than you have supply and prices go up. And so throughout this conflict, what we're seeing are crude oil prices going crazy. And then as we talk about more and more sanctions, that's another thing that's going to drive the price up. I don't know where this is going. I can tell you that I started driving back in the late 1970s, and I remember the gas lines. And I remember, I kind of remember that there was a day you could get gas and other days you couldn't. I don't remember if it was based on your birthday or Social Security. I don't remember. It's been so long. But I do remember lines forming and being in lines to get into a gas station to get gas. And I don't know if we're heading there or not, but I'll tell you, the prices are going up, the supply is limited, and I guess we're going to see how it all plays out. But it does certainly seem like it could be, a crisis on that end. Meanwhile, energy shares are doing quite well, as you might expect. And there you have it. Energy leading on Friday, up nearly 3%. The XLE now up over $75 on the close. We started the year at about 57. So that's not a transposition, 57 to 75. That's actually $18 gain in the XLE over just the first 2 months of the year. So 30%, pretty big move for energy. Financials, technology, discretionary, and communication services. Those were your 4 losers. Notice one thing, those 4 are all part of the aggressive, what I consider the 5 aggressive groups. But the 3 that I really watch closely are technology, discretionary, and communication services. And they're 3 of the top 4 on Friday to the downside. So it's not like the market's going down, but money is rotating back into technology and discretionary and communication services. The money continues rotating out of them. And I have a problem with that. And, I think we all should probably have a problem with that, at least in the near term. Does that mean every bottom has to form with money rotating back into technology on the final low? No, I've seen the market rally, and bottom without that, but it certainly helps. Just like at the top, the money was rotating into defensive areas back at the end of December, and that led the market to its final high. Well, a lot of times on these moves to the downside, that's what we want to see, is we want to see on the final low money rotating out of those defensive groups and back into areas like technology and consumer discretionary. And quite honestly, we're just not seeing that just yet. So I believe we're going lower. You know, the VIX is up in the 30s. We're going to talk a little bit more about the sentiment in just a minute. But anyway, as far as the action went on Friday, you can see not very good, mostly everything down, energy up. What else is new? Utilities also had a pretty nice day, and they're not shown here, but utilities had a pretty good day, and that's not unusual either when the market is weak to see relative strength in some of those defensive areas. 10-year Treasury yield. So this morning, there's no real economic news out for the next 3 days. I was looking ahead at the calendar. Today, tomorrow, and Wednesday, I really didn't see much of anything. I mean, there's like a preliminary business inventory report out, I think comes out on Wednesday or something. But outside of that, we really don't have anything until Thursday. And then we get the biggie. February CPI will be out Thursday morning. Now, I've shown charts where the market essentially has topped when we've come out with that report the last 3 months. Now we're actually rolling over a little bit with the S&P, and I'm going to get into, I'll show you the S&P in just a minute. But let's go ahead and let's take a look at the 10-year Treasury yield, then I'll get into that. But I just want to let you know, economically, we've got the CPI coming out later this week, initial jobless claims, of course, coming out on Thursday as well. And then consumer sentiment. Now, this is something that I think is pointing a little bit towards a recession. We have seen the consumer sentiment numbers dropping quite a bit, and they're expected to drop again for March. From the February level of 62.8, they're expected to drop to 61.7. So that number is going to be out on Friday morning. And then, of course, next week, we got the Fed meeting. So we've got CPI, which has not historically been a very good report. Market has not liked it. We haven't done well after these reports have come out in recent months. Then we've got the consumer sentiment number coming out on Friday. Again, I think that's been showing a little bit of signs, deterioration in the consumer and the confidence there. And as a result, that could lead us to a recession. And then you get the Fed, which has been saying, hey, we're raising rates. We don't care. We're raising rates. And okay. I'm trying to think of some nice things to say. That's why I'm silent right now, because I don't really have a whole lot of nice things to say. I'm not a fan of this Fed. I don't like the way they've handled issues in the past, written about it, talked about it. So I'm not going to go into a whole lot of it. I just think they're making a mistake. And without this crisis, without this war, maybe one rate hike to let everybody know that, hey, we're on this issue. We're here in case you need us. That kind of a message I could go along with. But to talk about multiple rate hikes in the face of this conflict and in the face of oil prices jumping like they're jumping, and in the face of consumer sentiment dropping, this makes no sense to me. And I'll go on record right now to say, if they make more than one rate hike, or if they have more than one rate hike, it's going to be a big mistake, and they will reverse course later this year. That's what I think. I honestly think that they should rethink raising rates at all right now, because I think if they raise rates, they're going to for sure throw us into a recession. Now, they might be more concerned about inflation than a recession, and honestly, they probably should be. But I think the inflation is going to get taken care of by itself. I think if you're already showing signs of economic weakness ahead, slowing demand will help take care of inflation to some degree. But anyway, the Fed's going to do what they're going to do. They have not asked me anything in the past. I suspect they're not going to call me and ask me before they come up with their decision. So it is what it is, and we'll just go along for the ride, and market will do what it does. But if you notice the bond market right here, 10-year Treasury yields dropped. Well, it's about up today, actually, 8 basis points. Let's get a quick update there. Make sure we got the latest. 7 basis points right now. But we've dropped here over the past couple of weeks from over 2% down to below 170, trying to hold on to this support. If we break below 170, I think the bond market's sending a very strong message to the Fed. Don't raise. This is the long end of the yield, the yield curve. The long end should go up if inflationary expectations are high. That should be one thing that drives sellers in the Treasury, in the 10-year Treasury yield. You wouldn't want to hold a 10-year Treasury yield for 1.8% in an environment where you're expecting inflation to run rampant. So this to me is the signal to the Fed. This is probably about all I would need to see. I don't think the 10-year Treasury yield really has gone up that much anyway. I mean, we were at historic lows, over the past couple of years, and to come back up to 2%, most of the time over the past 40 or 50 years that I've been involved in the stock market, I believe we would take 2% Treasury yields, 10-year Treasury yield. Now we have it and we're fearful. It's like, oh, this is horrible. We're up to 2%. It's really not that bad, to be honest. But anyway, I think the bond market is continuing to signal to the Fed to put the brakes on. And I don't know that they're going to. We saw it once before, end of 2018. They said they were going to raise, spooked the market, went into a bear market, and then 6 months later, they cut rates. They never raised. So anyway, let's move on. So I wanted to talk a little bit about this channel that we're in because, I've written articles. I talk about it quite a bit, but we also have a lot of new folks tuning in, and I want to make sure everybody's on the same page. I would not be counting on anything to the upside until this channel gets broken. I mean, this is just step one. We got the 20-day moving average we got to get through. If you connect the highs on the S&P 500 this year, I think it's pretty clear that we are in a channel. We are trending lower. We haven't seen anything like this in a long time. September into early October was not that big a deal compared to what we have right now. At least doesn't look like it to me. Here we had kind of a similar thing, but it just wasn't to the same degree. We had the down channel and then we broke. And once we broke, we're in good shape. Well, we've got to break this to even think about, have we bottomed? Otherwise, I think probably is just a little premature. The problem is the volatility index gets so high, the market gets so fearful that it needs and gets usually a snapback rally. And so here's that snapback rally. Here's a snapback rally. And you might say, well, we're still fearful. So, or should we still go higher? Flip a coin. Honestly, I don't know. Could we be up 50 or 100 on the S&P? Yeah. Could we be down 50 or 100? Yeah. Which way is it trending? It's trending to the downside. We're closer to resistance than we are to support. So my gut feeling would be careful. We could have another big sell-off. And usually when we get the big sell-offs, the panic sell-offs, and the market makers go on vacation, we get these big red candles and we get big swift moves to the downside. And then the upside, we get these little, we get one or 2 days of nice rally. And then it's just these little things that we're struggling to go any higher. And then we roll back over and it's rinse and repeat. So watch these trend lines, watch this channel. I would be very cautious. I'm still bearish short term. I'm bullish long term. And I've had questions come up. How can you be both? You got to pick sides. No, I don't. Long term, I like the market. I think the market's going higher. Short term, I think we got some issues. I don't think I need to pick. I don't think both have to line up. I don't have to be the same over the next month or two as I am over the next year or two. That doesn't make any sense to me. I think I've been pretty clear all the way since the top back in December. I was bearish short term going into 2022, wrote some articles about it. Thought we could really have some problems going in the beginning of this year. And we have. Further out, you want me to get bearish with an interest rate at 2%? I'm not going to do it. Where else are you going to put your money? There's secular bull markets. One of the reasons why they exist is that it's usually during a period when interest rates are declining or low. And there's nowhere else to go with your money. Earnings are much more valuable in that kind of an environment. So with rates sitting where they are, even with rate hikes, even if the Fed hikes rates. First of all, I think if they do, they're going to end up cutting later anyway. So we'll probably be back to square one. But even if they raise for a period of time, what if we go to a 10-year treasury yield of 3%? Oh my gosh, 3%. Wow. I mean, think about the history of the stock market and just understand valuations and how they work. 3% is not a bad thing. 4% isn't bad. 5%, I'm going to start getting a little nervous. And I think probably what's going to happen over the course of this decade, if I had to forecast long-term, I see the interest rates eventually rising down the road. We're not going to stay at 0, 2%, forever. So I think they're going to rise. And probably by the end of this decade, or maybe into the early next decade, is when I think we're probably going to start running into problems again and a potential secular bear market. I think we've got another decade or so of good market action overall. We're going to have cyclical bear markets from time to time. We're going to have corrections from time to time. We're going to have scares. We're going to have the VIX moving into the 30s and 40s. It happens. If you're a member of Earnings Beats, we did that anatomy of a cyclical bear market a few weeks ago. I showed you exactly how these things play out. And I think it's playing out right now, and we've got to have patience. So patience, being cautious, I think those are a couple things to keep in mind. Anyway, there's your S&P 500. Look at the NASDAQ. Now, this is an hourly chart, but I sent out in our daily market report to our members last week, literally almost when we were touching this trend line. If you connect the highs on the NDX, NASDAQ 100, we went up and tested that trend line almost perfectly. And if you drag this line down and keep the same slope of the line and connect the low from back in early December, guess what? It lines up beautifully with that January 24th low that we saw. So this is our channel for now on the NASDAQ 100. We are, we have maybe 400 points to the upside. We have a lot of points to the downside. And I'm not seeing signs that it's over yet. So I think we have to be kind of careful, in how we approach things right now. I still think, cash makes a lot of sense. Even if you're in cash and, you might say, well, why aren't we shorting? Why aren't we doing more? Well, I've talked about doing a little bit of shorting. I'm not a big fan of shorting. If I do, I go usually with the inverse ETFs that track the major indices. I don't like shorting individual stocks. I mean, I like most of companies. I like most of their management teams. I mean, most of these companies that are coming down are great companies. Last thing I want to do is be shorting them and have them turn around and go back up while I'm sitting in a short position. So if I believe the overall market could struggle, I like to do inverse ETFs on that. Sometimes the juiced leveraged ETFs like QID, that's double the inverse NASDAQ 100. So if the NASDAQ 100 goes down 1%, QID goes up 2% in theory. That's the way it's supposed to work. And so that's one way around not being able to short in a retirement plan. You can still buy the QID in a retirement plan. It's a long position, but it benefits when the market goes lower, just like a short position would. And I'm not recommending that anybody put their retirement into a leveraged inverse ETF, please. I'm just saying that that is the approach that I take from time to time if I really believe the market's going lower, rather than trying to short individual stocks. But everybody can do their own thing. I just look at the market, tell you what I think, and it's completely up to each individual to do with that information what they choose. And I'm not going to be right all the time. I'd love to be, but I'm not going to be, and I haven't been. There have been plenty of times when I have been wrong as well. So how this all plays out, I'm not sure. I don't think we bottomed yet. I still think that 3,800, maybe even 3,500 could come into play. Got a lot of negativity still in the market. The Fed, let's give them room to really screw up. I mean, they're probably going to. They've done it before. And I think they're brilliant people, by the way. I'm not trying to, talk bad about them in that sense. I just don't think this particular Fed has had a great track record. They get it right eventually, but in the meantime, portfolios are going all over the place. And that's the part that bothers me. So we'll see what they do next week, and we'll see how the inflation comes in this week. And then of course we got crude oil. We got all kinds of issues that we're going to deal with. And so the market normally climbs that wall of worry. I think right now there's just too much worry. And honestly, there was not enough bearish sentiment in the market to begin the year, looking at the equity only put call ratio in particular. And so that has been something that, needs to play out. All right. Let's move on. I want to talk, I've been getting so many questions. I've had so many questions. I want to apologize to anyone out there who has sent me a question probably over the last 30 days or so. For a while, I was having an issue with my email, but I do have my email up and running, but I've had so many questions come through, and I just haven't had time to get back to a lot of folks. So one thing I want to do is maybe start addressing some questions during the shows. And one question that had come in, and I thought it was relevant, even though the question came in a few weeks ago. I thought it was really relevant with what we're dealing with right now. And the question was just basically, and there were multiple questions, so I'm kind of paraphrasing a little bit, but essentially the questions that were coming in was they were wanting to know about the CPCE, the equity only put call ratio, and the VIX, and how I use them on a day-to-day basis in trying to come up with market tops and bottoms. The first thing I would say is I don't usually you don't see me talking too much about sentiment for market tops. I think sentiment sometimes gets bullish for an extended period of time and it remains bullish. And so if you start to get bearish every time the VIX or the CPCE turns bullish, I think you wait so long for the market to go down and you just miss out on stuff to the upside. So I don't find sentiment to be nearly as useful in trying to mark tops as I do in marking bottoms, because if there's one thing we can count on in the stock market, it's that if prices go low enough, panic will set in, and sentiment will help us spot that panic. So if you look at the major bottoms in the stock market throughout history, you are going to see really high levels of VIX and very, very high readings on the equity only put call ratio. And I'll just demonstrate here. This is an S&P 500 chart that goes back to last year. And I've got two panels below. One is the 5-day moving average of the equity only put call ratio. And the other is the 5-day moving average of the VIX. And if you want to know how you set this up in stock charts, down under the indicators here, I just use price. I put the $ CPCE, $ VIX, they're your two, equity only put call ratio and volatility index. Chart style, I moved to invisible. And that's down near the bottom of all these different possibilities. And so if I didn't do anything else, we would just have nothing on the screen. It would just be blank. But what I added was an overlay, a 5-day overlay, because it's a daily chart. It's 5-day. So 5-day simple moving average is on here. So that's all you're seeing. It just smooths out the information that you get, rather than seeing the VIX going up and down like a yo-yo and the equity only put call ratio. One day it's 0.8, next day it's 0.45, and you're just kind of going back and forth. This helps to smooth it out. In the short term, if you look at the bottoms, check out this bottom right here, beginning of October. You can see equity only put call ratio was near, at that point, 6-7 month high. As this ratio moves up, it means that more puts are being bought versus calls. More puts are being traded versus calls. Well, puts are more bearish. And so humans, when things start to go down, think, oh, they're going to keep going down. So I'll start buying more and more and more puts. Well, what happens is we get to a point where you got market makers on the other sides of the trades. And just when everybody feels like the market can't go anywhere but down, it goes back up. And so almost every bottom you see, I mean, if you take a look at these bottoms, almost every one will coincide with a spike in the 5-day moving average of the put call ratio. I mean, almost every single one. I mean, this is such a massive chart to keep watch on, not just when we're in a cyclical bear market, but anytime. You pull back for a week or two, see what's going on in the options world. If you're starting to get to highs where we've typically in the past seen bottoms, then jump in. And that was working fine in 2021. The problem now is that these highs were not really highs if you go back many years. I mean, if we go back 10 years and you look, these were the highs we were just looking at. Look what, I mean, these weren't highs. These were just highs because everything was so complacent. These were highs back during the rest of the secular bull market. Normal highs would be about 0.80, 0.85, 0.90. And if you notice, those highs also mark major bottoms in many cases. I mean, it's unbelievable. It's like clockwork. So we've gotten up a little bit. This is the resetting process that I think we're in right now that we need to go through. Look back in 2014, how we were down here. We got down in the 0.4s. And you look over the next year, year and a half, how we kind of reset. The market went nowhere. Everybody started getting a little bit more bearish. And then once we got up to this level, then the market was ready to launch to the upside. So I think this is the process we're in right now, is that, yeah, we're going to have these spikes that are going to mark short-term bottoms, and then we rally, but we need to go through more of this back that we saw in 15 and 16, or even back in 2018 when we saw, movement back up to 0.8, 0.85, 0.90 on a 5-day moving average. We're not there yet. So I think we got some issues still to deal with. All right. Anyway, that's the way I use the CPC, and the VIX is no different. Now, part of the problem right now is that they're not lining up together. Here you can see both the 5-day and the VIX spiked. Here, both the 5-day CPE and the VIX spiked. And both of those coincided with bottoms in the market. Here, we had a spike and we were moving up over here. This was a little over a week ago, week and a half ago. And we rallied off of that. The problem now is that on this latest rally, Wall Street has gotten complacent again. And so now we have a mixed signal on sentiment. Volatility is shooting higher, but your put call ratio is not. So I'm not seeing the same suggestion that the market's going to rally from here. I'm not saying it's not going to. I'm just saying that we might need to see more weakness to get this 5-day moving average of the CPCE up before we put in what, in my opinion, would be a much more potential, much more significant or potential bottom. So anyway, that's the way I use the short-term CPCE and the VIX. So hopefully that helped a number of you had questions about that. All right, let's take a quick look at the 3 you must see. I'm not going to talk about earnings. Really, there's no earnings out to talk about. I think Ciena, CIEN, was reporting this morning. But other than that, no really big companies reporting today. So I'm just going to jump into the 3 you must see, and we'll wrap this up. First, I'm going to do 3 industry groups that you may or may not be aware of, but these groups are really moving to the upside. So if you're looking on the long side, you don't want to short, but you don't want to sit in cash. You want to look for long opportunities. They're pretty much are always long opportunities. Something in the market usually is doing well on a relative basis. We know energy's been doing well, so I'm not going to focus on energy. I'm looking outside of energy. Defense stocks, wrote about them recently. Big move here over the last 7 or 8 trading days. Huge move. And of course, it has to do with the conflict that's going on across the pond. You look on a relative basis, it's broken out. On an absolute basis, it's absolutely taken, just taken off. So that's one group. Another group, I haven't talked about this group yet or much, but the mobile telecommunications group. We're at about a 5-month high right now, looking back to the highs back in early October. Trending higher, moving up through the moving averages. Look at the relative strength here versus the S&P 500. This has now been going on for about 3 months. So even when we weren't going up, we were just sideways consolidating, we were outperforming because the market was going down in January and mobile telecom was not, didn't go down to a new low. It went down, but it didn't mark a new low. So it outperformed the S&P 500. Now it's actually breaking out and trending higher. So, I mean, these are the kinds of stocks that you might consider on the long side. Companies that are just doing, or areas of the market that are just doing better in this market environment. Another group you may not be aware of, and this is the final 3 you must see, is railroads. I was actually surprised to see railroads make a big move last week, but huge move. We did make a breakout. Maybe we pull back to the moving averages or maybe close to this 3,600 level, which was the breakout area. But this is a group that on a relative basis, it just made a breakout to a new 52-week high versus the S&P 500. Not only that, but in last week's rally, look at the volume coming in. So really strong action in the railroad. So those are just three groups maybe to keep in mind. Let's see, we're 5 minutes into the market, see what's going on here. Dow down 237, S&P down 20, NASDAQ only down 17. So, I mean, we definitely have seen the rally. Small caps are moving into positive territory. And the thing to keep in mind is this VIX right here. It's at 33. Now, I know it's wonderful to be able to call the market in the near term to say, hey, it's going to do this over the next 24, 48 hours. All I can tell you is that when the VIX is up in the 30s, you've got just as good a chance of picking the right direction by flipping a coin. And the movements can be crazy in both directions. I mean, just look overnight at what happened. It looked like, I mean, the NASDAQ at one point was down 200. The futures. Now we're down 17 the next morning. Where are we going to be at noon? I don't know. We could be back down 200. Maybe we're up 200. I honestly don't know. We are in a range. And when you get this kind of volatility, I think it's very hard to figure out which way the market's going to go. And that's why I tend to be in cash. I know that we're in a fearful environment. So I've been a big fan of gold. Gold tends to do really well when the market is fearful. I think that this market certainly qualifies as fearful. We've been hanging around 30 or in the 30s on the VIX almost all year, maybe, you know, low 20s to mid to upper 30s. So it's been a difficult market, and I think it's going to remain a difficult market for the foreseeable future. But economically, we're going to find out with Thursday's report on the CPI, and then we're going to get the sentiment numbers on Friday, and we've got the Fed coming up next week, next Tuesday and Wednesday. And I honestly think they're going to mess up, but I think the market actually is pricing in the fact that they're going to mess up. So it's kind of crazy when you think about that. So now you got to try and stay one step ahead of the crowd, which is already one step ahead. So we'll see what happens. Anyhow, that's all I had for today. Looks like renewable energy. See a couple of renewable energy stocks doing well. So it looks like those are performing well today. Anyhow, everybody have a great day. I'll be back tomorrow over at Stock Charts TV. It'll be a recorded session of Trading Places Live, but that will air at 9 a.m. tomorrow Eastern. So if you go over to Stock Charts TV at 9 o'clock tomorrow morning, you'll be able to hear the next episode. Everybody have a great day. Be careful out there. It's going to be crazy and wild for the next, I don't know, a couple of weeks anyway. Take care and stay safe and be cautious. Happy trading.